An interviewer gives you one PE fund case. LPs commit $100 million. The fund calls 40 million. It invests 35 million. It accrues management fees. The investment is later valued at 50 million. Then it exits for 60 million. Most candidates can record one or two entries, but the strong candidate answers four questions after every event. Did cash move? Did NAV move? Was it capital activity or performance? And what reaches the LP statement? That is the PE fund accounting scoreboard. Keep that scoreboard in mind throughout this case. First, the LP commitment. Commitment is not cash. It is only a promise to fund when capital is called. So if an LP commits 100 million, the fund has not yet received 100 million cash. Then the fund calls 40 million. Now cash comes in. The entry is simple: debit cash, credit LP capital or contribution. But here is the interview trap. Cash came in. Performance did not improve. A capital call is capital activity. It increases fund capital, but it is not a gain. Next, the fund invests 35 million into a portfolio company or an SPV. The entry is debit investment, credit cash. Again, no profit is created on day one. Cash has only changed form. It became an investment asset. So the answer is not the fund spent money. The senior answer is cash moved. NAV did not improve because of performance, and the investment now needs to be tracked, valued, and reported. Now the fund records a 1 million management fee. This is where many candidates confuse accrual with payment. When the fee is accrued, debit management fee expense, credit management fee payable. This reduces NAV because expense hits the fund. Later, when the fee is paid, debit management fee payable, credit cash. If the fee was already accrued, the payment does not reduce NAV again. It only settles the liability. That is the senior interview point. Accrual moves NAV, payment moves cash. Now the investment bought for 35 million is valued at 50 million. No cash has arrived, but NAV still moves. Why? Because the investment is marked to fair value. The entry is debit investment, credit unrealized gain. This increases NAV, but it is not cash profit, and it is not realized yet. This is one of the most important PE interview traps. NAV can increase before the fund receives exit proceeds. The fund may look better on paper, but the gain is still unrealized until exit. Now the company exits for 60 million. Many candidates make a big mistake here. They say realized gain is 60 million. No, 60 million is exit proceeds. It is cash received. The gain is the profit element. If cost was 35 million, the total economic gain is 25 million. If the investment was already marked to 50 million, part of that movement was already sitting as unrealized gain before exit. At exit, accounting may reverse the unrealized portion and recognize the realized gain. So remember this line: cash received tells you proceeds, accounting tells you gain. That difference matters for NAV, performance reporting, and the LP statement. Now comes carried interest. Carry is not just money paid to the GP. It is a waterfall and allocation question. If the fund has returned capital, met the hurdle, and generated enough profit, carry may accrue to the GP. That carry can reduce the amount attributable to LPs even before cash is paid. So the trap is carry accrual is not carry paid. Accrual affects NAV or allocation. Payment is settlement. A junior answer defines carry. A senior answer explains when carry is accrued, when it is paid, and how it affects LP reporting. Now connect the whole case to the investor. The LP statement may show commitment, capital called, uncalled commitment, contributions, distributions, NAV or capital account, realized gain, unrealized gain, management fee impact, and carry impact. This is where PE fund accounting becomes more than debit and credit. The entry is only one part of the answer. The real interview answer follows the event from cash to accounting to NAV to investor reporting. So before answering any PE fund accounting question, use this final checklist. Did cash move? Did NAV move? Was it capital activity or performance? Was it realized or unrealized? Was there an accrual? Was there a payable? Was there a valuation movement? Was there a distribution? And what reaches the LP statement? If you can answer those questions, you are not just memorizing capital calls, fees, carry and exits. You are explaining the PE fund workflow. And that is what interviewers remember. Comment below which PE accounting topic you want next. Capital calls, management fees, carry, exits or LP reporting. Subscribe to the Fund Desk for more fund accounting interview guides.